The Dollar War. Podcast Script, Episode 4 of 4. What should you actually do? A practical investment guide for the middle class in a fracturing financial world. Produced, June 2026 for middle-income earners in the U.S., Canada, Australia, and the broader Western world based on IMF data, Federal Reserve Research, J.P. Morgan 2026 Gold Outlook, BIS Quarterly Review, Bloomberg Consensus Forecasts. Let me tell you about a family I'll call the Mitchells. 2 incomes. Combined household salary of $140,000 a year in a mid-sized American city. They own a home, they max their 401k, they have $45,000 in a savings account earning 4.8% interest. By every conventional measure, they are doing everything right. And over the past 3 years, they have lost ground. Not in nominal terms. Their numbers went up. But their purchasing power, what their money can actually buy, has declined. The grocery bill is 30% higher than it was in 2021. Their property taxes went up when the house was reassessed at its inflated value. Their health insurance premiums increased again. Their kids' college fund is growing, but the cost of college is growing faster. They are not poor. They are not failing. They are doing everything the financial advice industry told them to do. And the system is slowly, quietly, extracting value from them anyway. In the first 3 episodes of this series, we talked about why this is happening: China's gold accumulation, the Fed's policy cycles, the BRICS financial architecture, the fracturing of the dollar-dominated world. Today, we talk about what the Mitchells, and you, can actually do about it. This is Episode 4. The Practical Chapter. Let's get into it. Part 1. Understanding your actual enemy. It's not inflation. It's the specific way inflation is being engineered, and who benefits from it. The shearing the flock problem. In the previous episodes, we discussed what financial historians and commentators sometimes call the Fed's flock shearing cycle, and it's worth being precise about what this means before we talk about how to respond to it. The pattern looks like this. Phase 1, loose money, interest rates are kept low, sometimes near zero. Credit is cheap. Asset prices, stocks, real estate, bonds, inflate. People who already own substantial assets get significantly wealthier. Middle-income earners, who are more reliant on wages than on asset appreciation, see their cost of living rise but their savings accounts earn almost nothing. Phase 2, tightening. The Fed raises rates to fight the inflation it partially created. The cost of servicing debt rises sharply. New buyers are priced out of the housing market. Small businesses with variable rate loans face margin pressure. The middle class, which tends to carry more debt relative to assets than the wealthy, feels the squeeze disproportionately. Phase 3, the pivot. Eventually, rates come down again. Asset prices reinflate. Repeat. Over each cycle, something structural happens. The wealth gap between those who own productive assets and those who primarily own their own labor widens. The Mitchells, who are good savers but whose primary financial asset is their earning capacity, fall slightly further behind relative to those with large investment portfolios. This is not conspiracy. It is the predictable outcome of a system whose monetary architecture was not designed with their interests as the primary consideration. The good news. Understanding the mechanism tells you exactly how to position yourself within it. The 2026 context, why this particular moment matters. Most of what follows is advice that would be broadly sound in any environment. But 2026 presents a specific set of circumstances that make certain choices more urgent than they would otherwise be. Gold is at historically elevated levels, roughly $4,200 per ounce in June 2026, down from a peak of approximately $5,589 earlier in the year, still roughly 23% above where it was 12 months ago. J.P. Morgan's current consensus forecast is $4,753 per ounce average for 2026, with potential to reach $5,000 to $6,300 by year-end. Central banks are buying gold at the fastest rate in 50 years, not as a speculative bet, but as a structural hedge against dollar weaponization. When the institutions that manage the world's reserves are this consistently bullish on a single asset class, that signal is worth taking seriously. BRICS financial infrastructure is becoming operational. CIPS processed $24.5 trillion in transactions in 2024, a 43% increase year-over-year. BRICS Pay pilots are underway. The petrodollar's monopoly on energy trade is being actively contested. This does not mean the dollar is collapsing. It means the dollar is facing a credible alternative for the first time in decades, and that slow erosion has implications for long-term dollar purchasing power. The U.S. national debt has crossed $34 trillion, and the interest cost of servicing it is now the single largest line item in the federal budget, exceeding defense spending. This math does not resolve cleanly. The options available to address it, tax increases, spending cuts, or monetization, all have costs, and historically, the cost of the politically easiest option, monetization, falls disproportionately on middle-income earners who cannot escape through offshore accounts or hard asset portfolios. These conditions are not permanent. But they are the water the Mitchells, and you, are swimming in right now.